I was with some parents from my son's sports team, and we got talking about interest rates today versus where they were in 2020 and 2021. If you've been living under a rock, I'll let you know, they are much higher. The good news is that mortgage rates are still below the historic average, but that's a whole nother video. So the parents and I got talking about why somebody with a low mortgage rate would even consider refinancing. I told them in my 15 plus years of writing home loans, I've seen it all. And of course, the obvious reasons came up. If someone is getting a divorce or needs cash to improve their home, or they could use their equity to buy a business or an income producing property. These are all valid reasons, but what I want to talk about today is a debt consolidation refinance. See, a debt consolidation refinance is a type of a cash-out refinance. But what I want to focus on is the consolidation part of that. For those of you that don't know, a debt consolidation refinance is when you use the equity in your home to pay off debts. You know, credit cards, auto loans, and student loans. These are all examples of this type of debt, but there are others. If you're not clear on what equity is, then let me clarify. Equity is basically trapped money, and it's trapped because you have to create a loan to access it. The way you figure out roughly how much equity you have is just to add up any outstanding loans that you have on the property and then subtract that from the number of what you think the home is worth. Not sure what your home is worth? Just write home valuation in the comment sections on this post, and I'll send you a link to a site that you can use. It's pretty accurate. Now, in a recent article by Business Wire in September of this year, Robin Wachner of CoreLogic said, on average, Americans have almost $300,000 in equity. That's huge. Now, this varies from market to market and person to person, but bottom line is, unless you bought your home recently, you could be sitting on a decent amount of equity. If you have a fair amount of equity, the next question is, can you benefit from accessing that equity? And I don't mean a nice vacation. I mean, can you financially benefit from tapping into that equity? See, with inflation hanging around 8% to 9%, the cost of most goods are high, and in some cases, much higher than just a year ago. And with the Feds potentially raising the funding rates a few more times this year, things could get much worse. I found an interesting article on consumer debt that was put out by Credit Summit, and they state that auto loans and student loans have doubled since the Great Recession. That was 2009, if you don't recall. And the average consumer has almost $93,000 worth of debt, and Generation X carry most debt at about $140,000. That's people my age, 42 to 57. The problem most people is that they don't start looking for solutions until their back's up against the wall. And I get it. Logical sense would tell you that refinancing your mortgage to a higher rate would just compound the problem. But if you wait until there's job loss or medical issues, then it just starts to compound on itself. See, a lot of people are living paycheck to paycheck, and one big financial surprise will cripple them. So, back to my original point. Why would somebody refinance out of a low rate into a high rate? To use a corporate term, it's called debt restructuring. If you have high debt and you're making only minimum payments, or you have very low in reserves, this post is for you. When considering a debt consolidation refinance, you don't compare the rate on your current mortgage versus the new loan. The new higher loan. What you have to do is you have to look at the interest rate, and more importantly, the minimum monthly payment you have on your existing credit cards, auto loans, and other debts. See, it's all about cash flow. And the best way to create breathing room is to lower your overall minimum monthly payments, creating better cash flow. One thing to point out is that when you roll your debt into your mortgage, that debt is now amortized or paid back over a longer period of time. That is the key to creating better cash flow. If you're saying to yourself, won't that create more debt since you're paying on that initial amount over a longer period of time and that compounds over time? Just wait. There's a strategy to avoid that, and I'll get to that in a moment. Bottom line is, if you're only making the minimum payments on your credit cards, you're never going to get out of that vicious cycle. I have a great tool that allows me to take all of the factors into consideration and clearly show a breakdown and comparison of doing a debt consolidation refinance. To address the concern about having your initial debt turn into more debt over time, here's my solution to that. The trick is to take that new improved cash flow and apply a portion of it to your new mortgage payment. That's right. If you free up, say, $700 a month by doing a debt consolidation refinance, you'll then make your new mortgage payment and apply a portion of that $700. This will prevent you from paying more on top of your current debt. I know it's a lot, but trust me, it's much easier to follow when you see it on paper. Knowledge is power, and I feel most people will make the best decision if the facts are clearly laid out before them. If you want to know how much you could potentially benefit from this type of refinance, just send me a message directly. We don't need to run credit or do anything invasive to do the analysis. My fear is inflation is going to be around for a while, and if we have a full-blown recession, there will be job loss. If you want to take control of your high-interest debt and see if you can increase your monthly cash flow, this could be a great option for you. Be proactive and don't wait. I hope this explanation helps. In the comments, you can ask questions or reach out to me directly. Okay? Take care, and I look forward to hearing from you.